Hello, I'm Sandy Weaver with Weaver Financial. Let's do the numbers. In a nutshell, in the second quarter, bonds gained a bit, but stocks gained a good amount. Inflation got over its early year bump up and headed down again. The June Consumer Price Index dropped from the prior month and rose 3% over the last year, down from May's 3.3% yearly gain. The unemployment rate came in at 4.1% on a rounding slip up, and the labor market is softening just a little. Retail sales had a nice increase last month. After 2 quarters, U.S. large companies are up 15%, but small companies have stalled, up only 2%. Overseas stocks are faring a bit better at 6%. Bonds are stagnant, returning a flat 0% year to date. The stock market seems to keep powering on despite a Federal Reserve that's proving reluctant to drop interest rates. A few pros are starting to whisper that the Federal Reserve may not drop short-term interest rates from their 5.5% level until 2025. The business media has done so much navel-gazing on interest rate cuts that other important facts can be overlooked. I keep reminding myself that above all, it's interest rates and corporate earnings. We're not going to get 6 interest rate cuts in 24. It might be 1 or none, as a couple pros are now saying. Yet, the U.S. economy is humming well enough, adding a nice number of jobs each month, 206,000 in June. Consumers are spending a la June's 5% retail sales increase, aided by solid growth in wages, 4%. Inflation is trending down again, mostly. Gross domestic product, GDP, is estimated at 2% for the second quarter, per the Atlanta Fed's GDP Now tool. First quarter came in at 1.4%, below estimate. So interest rates are staying put for now, but what about corporate earnings? Looking good. Earnings rose 6% in the first quarter, are estimated to grow 9% year over year in the second quarter, and 11% for 2024 overall. With a stock market priced at 21 times earnings, which is quite elevated, where do we go from here? Some pros have said we'll have a non-eventful summer, a drop before the election because historically that tends to happen, and then rise towards year end. Some pros see the market trending sideways the rest of the year. A few predict a correction is way overdue. I don't hear, even from the optimists, that it's up from here. The Magnificent Seven tech stocks have driven much of the S&P 500's 15% gain. Some pros worry that those companies make up a third of the S&P 500. This euphoric performance is due to a handful of stocks. Other pros shrug, saying the market has concentrated on winners this markedly before and does not signify a poor outcome. Large company stocks have returned far more than small company stocks year to date. Some of the discrepancy is due to this concentration factor. The small company stock indexes don't have that, while some is due to the higher interest rates. Small companies borrow more. Barron's listed some potential pitfalls that could derail the stock market. Inflation could bump up. The growing U.S. debt and the interest we're paying on it could move front and center. Big tech could crack. Perhaps artificial intelligence, AI, isn't so grand. Note the November election was not in Barron's list, and for good reason. You all have seen the chart on stock market growth under Democratic and Republican administrations at our meetings. Inflation in Europe is lower than ours, enabling their central banks to set lower interest rates. Their growth in GDP levels are lower. The 2 wars in Europe and the Middle East are difficulties they deal with. Their stock market returns are lower. China's market remains lackluster. We invest little there. Is diversification still worth it? Jumping on the large tech stock bandwagon with both feet would be a risky ride at this point. Yes, we do invest more in large company stocks than other asset segments, but history shows that bonds, small company stocks, and overseas companies all have their day in the sun. Using active and specialized passive funds helps us do better than the market indexes. We know that success comes easier for investors with a long-term time horizon than those attempting to predict which horse will cross the finish line first in the next 12 months. Thank you for your interest. Please call or email me if you want to dig in further. I'm glad to pass on my readings, podcasts, and the other sources.